Hi, this is Ankur Kapoor. In this video, we'll take one example to showcase how businesses are set up and how they grow and what goes in the background of the accounting entries related to those businesses. So let's get started.
Say you plan to set up a coffee shop and expect it to grow big. You have rupees 10,000 to start your operations, and this money is provided by your bank as loan. So let's see how the accounting works. When you borrow rupees 10,000 from a bank. So on the asset side, your initial cash is 0. After the transaction, 10,000 rupees come in, so that is the change, and at the end you have 10,000 rupees as cash with you, which basically means your total assets are 10,000 rupees. On the liability side, before you started your venture, there is nothing, you have 0 outstanding. You borrowed 10,000 rupees from a bank, and after this transaction, your liabilities stand at 10,000. So your total liabilities are 10,000, which is basically a loan from the bank. As you can see, both the sides of our balance sheet are equal, that is balanced. Now you spend rupees 7,000 on a coffee machine. Then you buy rupees 2,000 worth of coffee beans and milk. You keep the remaining 1,000 for making change and such. So in total you have spent 9,000, that is 7,000 rupees on a coffee machine and 2,000 rupees on ingredients. But that money hasn't disappeared. It's basically turned into assets and inventories. The 7,000 rupees that you spent on coffee machine is basically plant, property and equipment, while the 2,000 rupees on coffee beans and milk, that is categorized as inventory. Let's look at our asset side. So before, our cash is 10,000. We know that we have spent 9,000, so the change is 9,000, and after that is at the end we are left with 1,000 rupees as cash. Inventories, which is basically coffee beans and milk, we did not have anything before. The change is 2,000 rupees, and after is the 2,000, which is the end value. On the plant, property and equipment, we know that we have bought 7,000 rupee worth of coffee machine. So initially we did not have it. The change is 7,000 rupees. At the end we have 7,000. So our total assets are still 10,000. It's just that the cash has moved to buy coffee machine and coffee beans, and hence it has created inventories and plant, property and equipment. On the liability side, nothing has changed. We had borrowed loan from bank for 10,000 rupees. That stays at 10,000. So our total liabilities are 10,000. So now you open for business and you land up selling 30 cups at rupees 100 each within the first 2 hours. By noon, half the milk and coffee beans are gone. So your cost of goods sold is 2,000, which was the initial inventory amount, divided by 2, that is half. You're left with 1,000 rupee. So 1,000 rupee is spent on coffee cups that are served, and out of 30, 7 people didn't have any cash, so you let them buy on credit, which basically means you need to record 7 multiplied by rupees 100, that is 700 rupees in accounts receivable. And accounts receivable is basically the money that those 7 people owe to you. So let's look at our balance sheet. How does it look now? So on the asset side, we had 1,000 rupees. We sold 30 cups and we got cash from 23 cups, which is 23 multiplied by 100. So 2,300 rupees we got as cash. The end value is 1,000 plus 2,300, which is 3,300. On the accounts receivable side, we did not have anything outstanding, 0. Now those 7 people owe us 700 rupees. So at the end, 700 rupees stays in accounts receivable. On the inventory side, we started with 2000. 1000 worth of inventory is used. We are left with 1000 now. Plant, property and equipment, we started with 7,000. There is no change. We are left with 7,000. So the total asset now is 12,000. So our business is doing very well. We are anticipating even higher sales for rest of the day, and you run over the corner grocery store to buy more inventory worth rupees 500 so that you have enough material to serve your customers. But when you reach at the grocery store, you realize that you left your money back at the coffee shop. So you promise the grocer you will come back on Sunday, that is after 6 days, and clear the dues. We post rupees 500 to accounts payable, which is the money that you owe to the grocery store for the milk. Think of accounts payable like your credit card. If you buy a shirt on your credit card, you can use it right away, but you still owe the credit card issuer some cash. Let's look at our balance sheet. How does it look like now? So on the asset side, we had cash 3300. There is no change. It stays at 3300. Accounts receivable was 700. No change. It stays at 700. We got 500 worth of milk. So inventory initially was 1000. Now 500 is added to it. So the end value is 1500. On plant, property and equipment, we started with 7,000. There is no change. It stays at 7,000. So our total assets are 12,500. On the liability side, our accounts payable, which was nil earlier, now we owe 500 rupees to the grocery store. So after that is at the end, we are left with 500 rupees outstanding. And on the bank side, our 10,000 rupees stays. There is no change. We still owe 10,000 rupees to the bank. So our total liabilities is 10,500. We still see the difference between total assets and total liabilities. We can ignore that for now, since we will be covering as we get closer to completing this example. By the end of the day, you realize that your coffee machine must have suffered some wear and tear due to its continuous usage. The accounting name for this wear and tear is depreciation, which lets you record the fact that due to passing of time and usage, your equipment isn't as productive and hence valuable as it used to be. Depreciation is a cost of doing business, just like buying coffee beans and milk, because you will eventually have to buy a new coffee machine if you stay in the business. For the sake of simplicity, let's assume a depreciation of rupees 100 per day. In the real world, depreciation isn't recorded at the moment something starts wearing out. It's actually a regular charge that assumes that an asset wears out over a set time period. It could be as long as 40 years in case of a building, or as short as 3 years in case of a computer software. For now, let's work with rupees 100 per day as depreciation cost, which means that by the end of day 1, our value of plant, property and equipment has depreciated by rupees 100, and it is now worth 7,000 minus 100, that is 6,900. So after a long day of serving coffee, your balance sheet and income statement will look like this. On the balance sheet side, the assets on the cash, originally we had 1,000. At the end of day we have 3,300. Accounts receivable was 0. Now it is 700. Inventory was 2000 to start with. Now it is 1500. Plant, property and equipment was 7000. Now it is 6900. So total assets initially were 10,000 and now they are 12,400. On the liability side, we have accounts payable. It was 0 initially and now the final value is 500. We still owe loan of 10,000 rupees to bank. It was initially and now as well. That leaves us with a difference of 1900, difference between total assets and total liabilities. Well, this difference of 1900 is basically called retained earnings. So we started with sales. We were able to sell 30 cups for 100 each, so 3000 rupees of sales. Associated cost of goods sold was 1000. Depreciation was 100. So the net profit is 3000 minus 1000 minus 100, that is 1900. And as we have learned earlier, that profit is retained earning that we have to add to the liability side of the balance sheet. So now we see here that the profit, also called retained earning, is added and our total asset of 12,400 matches with total liabilities and equity of 12,400. Remember that retained earning or profits that are added back to the balance sheet are part of the equity. This share of money belongs to the owners of the business. So at the end of day, our net profit was 1900. We need to add back 100 rupees of depreciation, which was a non-cash charge. We did not pay any cash, plus 1000 rupees of inventory that was consumed as part of coffee cups that was sold, minus 500 rupees of inventory, that is extra milk purchased, minus 700 rupees of accounts receivable, that is money owed to you, plus 500 rupees of accounts payable, that is money owed by you to the grocery shop owner. So if you do the calculation, this will leave us with 2300 in operating cash flow. The key takeaway here is that the income statement and cash flow statement can tell different stories about a business because they are constructed using different sets of rules. The income statement strives to match revenues and expenses as closely as possible, but the cash flow statement cares only about the cash that go in and out of the door, regardless of the timing of the action that generated cash. If you were running this business for a long time, it usually takes a certain pattern. Most of the organization will have similar looking financial statements.
So one of the purpose of doing financial analysis is understanding this pattern for a variety of companies. This pattern will indicate the strength of the company. This pattern will also indicate if the management is trying to manipulate the accounting books. When you see it's a top quality management and doing a top quality work, that becomes your investment bet. Obviously, it is for long term. And when you see that there is some gap in the accounting, you run away. I hope you like the video. Thank you for watching.